As your next delivery goes through the last mile of its journey to your door, here's some companies trying to improve that journey and possibly bring in huge profits along the way. For example, SERV Robotics has robots built for short-distance deliveries, capable of carrying up to 50 pounds and traveling at speeds of up to 7 miles per hour. With 80% autonomy, the robots can safely navigate urban environments, avoiding obstacles and interacting with pedestrians, helping to address issues in last-mile delivery, such as high labor costs, driver errors, and fraud, by offering automation that reduces these expenses. Moreover, the decreasing cost of hardware, like sensors and cameras, makes automation increasingly cost-effective. As a result, robotic sidewalk delivery is cutting transportation costs, lowering emissions, and improving overall delivery efficiency, while contributing to reduced traffic congestion. Since launching in 2022, SERV has completed over 100,000 deliveries for partners like Uber Eats, 7-Eleven, Walmart, Shake Shack, Little Caesars, and Delivery Hero, covering major markets like Miami, Dallas, Atlanta, and Chicago. As business grows and the robot fleet expands, increased delivery volumes still maintain a high delivery completion rate of 99.8%, a good selling point that has likely helped raise significant capital, including a $90 million funding round, which provides a financial runway for scaling operations. SERV is also exploring new revenue streams in robot-based advertising and data analytics services. Technologically, capabilities have been strengthened through acquisitions, such as Phantom Auto and Voices, which enhance real-time connectivity and teleoperation features for its robots. This allows for smoother navigation in complex urban settings, a critical aspect for autonomous delivery in busy environments. While more robots keep being deployed across more locations, it's still important to note this business is still in the early stages of development and has not yet reached profitability. The fine print on the proverbial package also draws attention to the fact SERV has heavily relied on Uber for the bulk of its revenue as it gets off the ground. After all, SERV did originate from a spin-off from Uber in 2021. Uber provides support and recognition to gain market confidence, but leaning towards sole dependence is never a good thing, as it introduces risks related to concentration on one source of business. Additionally, external factors like supply chain disruptions, particularly in semiconductor availability, could delay production or raise costs. To mitigate these risks, SERV is diversifying its partnerships, which help expand its robot fleet and increase the utilization of its robots. The greatest example of this so far is its partnership with DoorDash, which captures more customers beyond Uber Eats. This dashing duo is initially serving on the sidewalks of Los Angeles, with plans for broader U.S. expansion, in line with SERV's established strategy of entering major metropolitan areas. Like with Uber, the partnership is expected to increase the volume of orders available to SERV's robots, tapping into the DoorDash user base and merchant network. From DoorDash's perspective, entry into autonomous delivery helps it deal with dependence on independent contractors, aka dashers, for delivery. Specifically in regards to challenges with retaining and attracting dashers, on top of external factors like immigration laws and labor regulations potentially reducing the pool of available workers. The platform also competes with other food delivery services, merchants, in-house delivery systems, and grocery delivery platforms for both customers and dashers. When looking at its core, DoorDash runs two primary marketplaces, DoorDash Marketplace and Wolt Marketplace, serving merchants, consumers, and dashers across over 30 countries. It generates revenue by charging merchants transaction fees and consumers a fixed delivery and service fee. It also offers subscription programs like Dash Pass and Wolt Plus to reduce friction and attract more customers. Additionally, DoorDash's reliance on merchants means that any decline in service quality or increases in consumer prices could negatively impact its operations. Inflationary pressures and rising operational costs could cause merchants to raise prices or renegotiate terms, hurting DoorDash's revenue and customer satisfaction. Also, because it faces competition from local on-demand services and must continually attract new merchants to maintain its growth. When talking about pricing strategies, factors like delivery fees, dashers, compensation, and merchant commissions are influenced by cost structures, market conditions, and competition. That's why anytime DoorDash considers expansion into international markets, it may require adjustments to these strategies' facets. In the bigger picture beyond food delivery automation, ARAI AI is transforming last-mile delivery with its autonomous last-mile ALM mailbox technology. This system enables secure, smart exchanges of goods between people, robots, and drones, positioning ARAI as a leader in autonomous delivery for all kinds of packages, including food. Its Mailbox as a Service (MaaS) model offers a subscription-based service for its ALM access points, smart mailboxes, combined with an AI-powered platform and advanced logistics technology. The ALM ecosystem is built around three main components: ALM access points, which are climate-controlled mailboxes that support autonomous deliveries, secure chain of custody, and features like theft prevention. The ALM platform, which provides AI-driven software for optimizing delivery routes, predictive maintenance, and dynamic pricing, and AI technologies, which improve efficiency as data is collected from deliveries. The system is already being tested with Fortune 500 companies, healthcare providers, and logistics firms to assess the return on investment and integration potential of these innovations. ARAI's MaaS model is designed to reduce upfront costs and complexity for businesses and consumers, making it easier for them to adopt autonomous delivery systems. As data accumulates, the company aims to refine its AI models for more efficient route planning and predictive maintenance, improving performance and cost-effectiveness. Revenue generation comes from three primary streams: MaaS subscriptions, data monetization through AI insights, and operational platform fees. These will cover everything from the hardware and software services of ALM access points to providing smart logistics tools like delivery scheduling and space optimization. ARAI plans to expand into niche markets like medical campuses, assisted living communities, and eventually into broader sectors like e-commerce and food delivery once it secures its core customer base. ARAI's technology is protected by an expanding portfolio of patents, including innovations like UV sanitization, battery exchange, weather sensors, and more, positioning it as a strong competitor in the growing field of autonomous delivery. Its leadership sees a massive opportunity, estimating that capturing just 1% of the U.S. addressable market could generate $3.5 billion annually. Globally, ARAI is forging partnerships to expand its reach. In India, it teamed up with Sky Air Mobility to roll out 60 ARAI points, enhancing drone delivery in cities like New Delhi. This collaboration aims to reduce carbon emissions, improve delivery security, and solve logistical challenges like theft and damage. In the U.S., Peachtree Corners, Georgia is home to a pilot program that integrates AI-powered smart mailboxes with 5G connectivity for secure, climate-controlled deliveries. To support its rapid growth, ARAI recently expanded its workforce by hiring 40 employees, including AI scientists and engineers, and partnered with Synoptech for IT and cybersecurity. Then, aside from going public in May on the NASDAQ under the ticker symbol ARAI, $12 million came from crowdsourced funding. Looking ahead, ARAI is also integrating cryptocurrency into its operations, offering Bitcoin payments and considering its own digital currency, ARAI Coin, to streamline transactions and attract top tech talent. And with over 60 patents pending, ARAI is gearing up for mass production of its smart mailboxes to bring mailbox modernization to the masses. Over in Southeast Asia, the super app called Grab has rapidly expanded its reach across countries like Indonesia, Malaysia, the Philippines, Singapore, and Vietnam. So on top of its broad geographic reach, it goes beyond food and grocery deliveries by offering other services like ride-hailing, digital payments, lending, insurance, and even digital banking through partnerships with GXS Bank in Singapore and GX Bank in Malaysia. Grab benefits from Southeast Asia's ongoing digitalization, urbanization, and a large, underserved population. It serves over 41 million monthly users with a highly engaged and diverse customer base and connects millions of driver and merchant partners on its platform. Grab's business model revolves around service fees and commissions paid by driver and merchant partners. In the delivery segment, consumers pay for goods, delivery, and platform fees, while drivers earn delivery fees, and merchants receive the value of their goods minus Grab's commission. In the mobility segment, drivers earn ride fees and consumers pay for rides, including tolls and platform fees. Financial services like GrabPay, lending, insurance, and GrabInsure generate revenue from transaction fees and interest income. The Grab ecosystem is designed to drive growth through network effects. As more consumers and partners join the platform, faster delivery times, more selection, and better service arise, attracting even more participants. This flywheel effect creates income opportunities for drivers and merchants while providing consumers with faster, more efficient services. Grab's technology stack is built in-house, including mapping, routing, and secure payment systems. It's also invested in automation, AI, and infrastructure to optimize delivery times and improve user experience. Its ecosystem includes Grab Maps, Grab Ads for merchant advertising, and services like hotel bookings and subscriptions. Moving along, focus will be directed at expanding its offerings in high-growth areas like groceries, financial services, and advertising, while improving its partner network's efficiency. Grab also plans to pursue investments and partnerships to complement its organic growth strategy, aiming for sustainable growth through technological innovations and localized solutions for each market. While that's underway, share your thoughts on how well you think each of these companies will deliver, and for more on stocks and crypto, follow Ascencore. See you next time.